lecture we will be talking about more on financial planning and budgeting. So in the earlier part of my lecture, I explained about what financial planning is all about. Basically, it's a process of comprehensive estimating the financial situation and framing a specific financial plan to reach your goals. So it talked about the different areas of finance which are dealt with when you talk about the financial planning, like the investing part, taxes, savings, retirement, estate, insurance and more. So tax planning was about minimizing the tax liability. Estate planning is about involving of setting up of a systematic plan that you will make in order to receive your assets when you pass away. The retirement planning is all about maintaining your lifestyle when you retire. Insurance planning was all about taking the insurance policies which are going to give you and take care of your specific risk needs as an individual and as a corporate. So you have to do the financial planning in order to take care of your income and expenses, in order to even control them, and in order to optimize and maximize your returns. So you have a specific goal in mind. You have to see to it that it is a guiding force when you plan, and you are able to have a complete catch on your future income as well as expenses. So managing your future needs, taking care of the sources of the funds, your full utilization and matching of the individual returns on the future investments. So we had talked about the individual investment plans and the corporate plans. So when you talk about the individual financial planning, you have to have a goal in front of you, you have to see about your retirement planning, maintaining a standard of living, buying a house, etc. Taking care of your investment portfolio so that you are able to have the best returns and you are able to monitor the conditions. So you can have a mix and match of the shares, bonds, future funds, fixed deposit, real estate, etc. You have to manage the funds so that you are able to give the less amount to the government, learning about more on equity linked saving schemes, etc. You have to set your priorities, you have to keep monitoring. Now coming on to the next aspect, that is the objectives of financial planning for the corporate. Now as a corporate and individual, if you compare, there are certain steps which are different in nature, because as an individual you have your scope, your spectrum is very narrow because you are into the picture. But when you talk about the requirements of the financial planning for the corporate, the overall structure is entirely different. The first step of the financial planning is to determine the need of what capital would you want for an individual or an enterprise. So this will depend upon the various factors, like when you have to raise the funds, you have to see what is the cost of assets, what is the cost of capital, working capital requirement for your day-to-day expenses, and the capital requirements have to be considered with full term and long term aspects. You have to determine the capital structure of your company. So the capital structure is, when you talk about, it is the composition of the capital, like what amount of equity shares, preference shares, reserves and surplus, that is the total equity. What is the structure of debt, bonds, that is the total debt of your company, and the total capital of the company A and B in this illustration which is in front of you is 22 CR for company A and 30 CR for company B. But if you see the debt structure of A and B, B is having 10 crores total debt and the total debt for company A is 2 crores. Whereas if you talk about the total equity investment, it is the same for company A, that is 20 CR, and for company B, it is also the 20 CR. So let us analyze more on this. So here when you talk about the total capital of 22 CR for A and 30 CR for company B, the equity holding is 90.90% in case of company A, and total equity holdings for company B is 66.66%. So total debt is 9.1 in case of company A and 66.66% of company B. So debt equity ratio is 10% for company A and 50% of company B. So these are the key highlights of the corporate investment in terms of the financial planning and actualities of company A compared to company B. Company A has less debt as compared to company B, and debt equity ratio of company B is 5 times as compared to company A. Higher debt shows high cost of fixed interest payment to the investors. So framing the financial policies. The next step is to frame the policies based on capital structure and financial goals. So it includes the cash, credit management, inventory management, etc. So here what you have to do is you have to monitor your financial plan. So the financial planning is a continuous process which involves the constant monitoring of the financial activities. Financial plans are built to maximize the utilization of financial resources with the least possible cost. There are huge, substantial benefits of financial planning. Let us have a look on this. The benefits of financial planning, the first and the foremost, is to ensure the availability of the funds. It supports the long-term development of an enterprise. It helps in reducing the cost. It helps in estimating the trust among the investors. It also improvised the flow of fund. It also increases the return on investments. Definitely, there is an importance of doing the financial planning. The first is, it facilitates the collection of optimum funds. The financial planning helps in timely requirement of funds. It ensures the wastage and overcapitalization situation. It helps in fixing the most appropriate capital structure. 1. It helps in selecting an appropriate capital structure. Number 2, appropriate capital structure helps in meeting of short-term, medium-term and the long-term requirements. It also helps in investing the finance in the right kind of projects. It also helps in comparing the investment proposals. It also guides in the different allocation of the funds which are available to the company. It also helps in operational activities. Operational activities are the key business activities of an enterprise. The success or the failure depends upon the financial decisions as the right kind of decisions. It also ensures the smooth flow of finance. Now coming on to the base for the financial control. Financial planning also guide in the financial controlling. It involves comparing the actual revenue with the estimated revenue and the actual cost with the estimated cost. It helps in the proper utilization of finance. It helps in proper utilization not only of the finance but also it reduces the risk and maximize the returns. Now coming on to individual or the micro factors that affect the financial planning. These micro factors include the family structure, that is the spouse, children or dependents affect your financial planning. Your attitude towards and the tolerance of the risk also gets affected. Typically, both the willingness and the ability to assume the risk diminishes with the dependents. With having more dependents, the need of the financial protection grows. The second is your health. The health also affect your expected income, needs and the risk tolerance and thus affects the personal financial planning. The financial planning must include the protection against the risk of illness, accident, and the long-term disability. The third is your career choice. Your career also affects your financial planning. Different career options have the different working hours, different salary structures, the benefits which you get from that particular career, the risk factors, etc. For example, most athletics have short careers and end before the middle age. They have higher risk of injury, command steady, and higher than the average incomes. On the other hand, most sales representatives have a longer careers with greater risk of unpredictable income fluctuations. On the similar pretext, we have the account managers, human resource managers are similarly working professionals, have a long career with less risk of undictatable, unpredictable income fluctuations. Then the fourth important factor is your age. The needs, desires, values, and the priorities of an individual change over different phase of lifetime. Similarly, financial concerns, they change accordingly. Like you have here the young adulthood, middle adulthood, older adulthood, and the retirement. So when you talk about the sources of income, when you are young, the resources are wages. When you're middle, it is wages and investment. When you're older, it is wages and investment. And when you retire, it is only the investments. And when you talk about the asset base, when you are young adulthood, it is none. The second is your accumulating. When you are older adulthood, it is growing. And when you are retirement, you are the using up part of the asset base. Similarly, when you talk about and compare the expenses at the different ages of the investor, the young age old expenses are low. They grow when you are at the middle age. Again, older, it is growing, and when you retire, it is low because you have to be confined in your house, your requirements reduce, your total over expenses also, they substantially are lowered. Now, when you talk about the risk ability, it is low in case of young, and of course, when you talk about the middle, it is higher. In case of older adulthood, it is also higher, and when you retire, it is high. Then you have a risk willingness. Risk willingness is high in case of young adulthood. It is when you talk about the middle adulthood, it is lower. Older adulthood, it is again lower. And when you retire, it is against very low. Now coming on to the financial planning process. The first is you determine the goals. The next is your assessing the current situation, identifying the choices, evaluating the choices, and eventually you have to select a particular choice. So this is how the different part is done when you talk about the financial planning process. The last step of which is assessment. So we have SMART goals. So let me elaborate this. When you talk about the SMART goals, the S stands for specific. The goals are you need to know exactly what you want and when. The incorrect approach is I need money to pay my college fees in a year's time. Whereas the right approach is I will save the money of rupees 50,000 to pay my fees of the college. So this is a very, very specific goal and objective, the right kind of approach and the incorrect approach. So when you talk about the SMART goals, the S is specific. Now coming on to the second part of SMART objectives, that is the M part. The M is measurable. So your goal should be measurable so that you know when you can achieve it. So the correct approach is I will pay off my debts to my friends. Whereas the right approach is in the next 6 months, I will return rupees 3,000 to my 2 friends for lending me the money. So this is measurable. So when you talk about the financial planning, financial management, and anything and any perspective relating to finance, you have to fix your SMART goals. The first we have already explained is a specific one. The second is a measurable. The third is attainable. That is the practicality part of it. So your goals should be reasonable enough so that you are able to achieve them. The right approach is I will save rupees 2000 each month by cutting down my eating out and partying. Whereas the incorrect approach is I will save money. So when you say I will save money, this is highly impractical way or unattainable way of your goals. So when you talk about the SMART goals, we have done as of now, the S is that is specific, SMART M is measurable, and SMART A is attainable. Now coming on to the R part of the SMART goals, that is realistic. So the goals is your goals need to be based on the resources and the task that you can reasonably accomplish. The incorrect approach is if I saw money, I will be rich. Whereas the right approach is if I save regularly, need not borrow the money, I can pay off my debts by next year and will have enough savings till I begin to earn. So these are the SMART objectives, and the last part of the SMART objective is time bound. So the goals with the timeline, they allow you to track your progress and encourage you to keep going until you reach your goals. So the incorrect approach is I will save money for my vehicle. Whereas if you talk about on the contrary, what the right approach tells you is I will save rupees 10,000 a year for the next 2 years for my vehicle. So this was the SMART objective explanation, keeping into consideration the goal part of it, the correct and the incorrect approach. So these part are very, very important to be keeping into consideration in this regard. So now I'm going to start with the financial plan, that is the budget. Now what is budget? Budgeting is the process of creating a systematic plan to manage your money and control your expenses. So this specific and systematic plan is called as a budget. So let us do the process part of it. What is the budget process? So you have to define the goals and gather the data. You have to form the expectations, that is the reconciling goals and data, followed by creating the budget, monitoring the outcome, analyze the variance and adjust the budget expectations of the goal. So this goes in a cycle, and this is the process of the budget. Now coming on to the different parts of it. The first is define goal and gather the data, reconcile goal and the data, create the budget, monitor the outcome and adjustment of the budget in light of the first 4 points. Now coming on to the different types of budgets. The first is the operating budget. Operating budget refers to day-to-day expenses and the sources of revenue. They are further divided into major categories such as revenues, salaries, benefits and non-salary expenses. The second is your capital budget. The capital budget refers to estimation of capital requirement. It helps in purchases of large assets like property, equipment, IT systems that create major demands on an organization cash flows. It also helps in allocation of funds, controlling the risk in decision making and setting of the priorities. Now the third type of budget is a cash budget. The cash budget involves all cash payments and the receipt of cash from revenues. The cash budget helps in the management of cash flows effectively. 50-30-20 rule. Divide your income into 3 parts. and allocate it according to the following percentages. 50% towards the needs such as payment of the rent, food and the minimum payment on the credit cards and the other debt. So half of your income should be allocated on your daily needs. 30% for the wants such as going to a holiday trip or the entertainment, and 20% towards the savings, which can include a debt. So this 50-30-20 rule is a golden rule which helps you in allocating of the funds and giving a very sustainable life. 50 towards the needs, 30 towards the wants and 20% towards the savings. So what is the importance of creating a budget? Budgeting helps in controlling your spending. Budgeting helps in controlling of your spending and unnecessary expenses. It helps in tracking on your activities, spending habits, and help in understanding the improving the financial position over time. And of course, the budgeting helps in achieving your financial goals. It helps in guidelines to follow towards achieving the target objectives, and budgeting also helps you to prepare for emergencies. Budget helps to meet out the emergencies, like an example of the above situation what we have done. Budgeting helps in keeping a record of all your income and the possible expenses. It also guides us in investing the surplus money. Now, what is a budget surplus? A budget surplus is a situation when income or revenue exceeds the expenditure. And in case of budget surpluses, additional money can be reinvested or used to pay off the debts. Now coming on to what is a budget deficit. A budget deficit is a situation when expenditure exceeds the income or the revenue. In the case of budget deficit, additional money needs to be raised in order to meet the deficiency. A budget deficit is a situation when the expenditure exceeds the income or the revenue. Like for example, the following table shows the sources of income. The first is the salary of Mr. A is 6 lakhs, of B is also 6 lakhs. The bank interest which Mr. A has to pay is 30,000. The sale of the land is 70,000 and sale of the gold for Mr. B is 70,000, which makes a total of Mr. A is 7 and B is 7. And on the similar pretext, we have the expenses of housing each equally for A and B, transportation equally for A and B, and educational aspects equally for A and B, and the total personal expenses equally for A and B, which makes a total of Mr. A as 6,30,000 and 9 lakhs for Mr. B. So now is the analysis part. Mr. A has a budget surplus of 70,000. Mr. B has a budget deficit of 2 lakh rupees. So these are the strategies to reduce the budget deficit. Know your monthly income. In order to reduce the deficit, one must know all the sources of the monthly income. In case of the higher deficit, an individual many times search for extra income like part-time jobs, overtime, incentive-based work, commission, etc. Know your monthly expenses. Similarly, in order to reduce the deficit, one must know all sources of its monthly expenditure, and in most of the cases, mostly expenses is inconsistent. Monthly recording of all expenses can help in tracking the unnecessary expenses. So in case of the higher deficit, an individual reduce or cut down the unnecessary expenses like personal expenses, and the personal expenses may include laundry, cell phone services, clothing, personal care, etc. You have to plan your spending to match your income. So the last step to reduce the deficit is to match your expenses with your income. By reducing your expenses and increasing your income sources, an individual may raise its saving. So this can be explained with the help of an example. The sources of income, the salary is 6 lakhs, the saving interest is 30,000, the fixed interest is 10,000, and the total part-time job. So this is 6,40,000, whereas the housing, expenses, transportation, personal includes it as 9,40,000. So in this example, Mr. B has a budget deficit of 3 lakhs, that is 6,40,000 minus 9,40,000. So Mr. A must find the new sources of the income in order to raise this additional income level, and this may include the part-time job, commission, as well as the bank interest.